Have you heard of the couch potato portfolio? It's a simple investing model that I've really liked over the years, but there's one thing that bothered me, that the Canadian market was given the same weighting in the allocation as the US and international markets. Noah Solomon from Outcome Wealth Management joins us on the show to discuss how Canadians are overinvested in Canada, whether they're following the couch potato portfolio or simply choosing stocks and mutual funds. Plus, we discuss how to become more diversified, leading to stabilized returns and less risk. Welcome to the MapleMoney Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Our sponsor, Borrowell, provides personalized product recommendations from credit cards to mortgages and loans from trusted partners, tailored just for you. Head over to Borrowell to get your free credit score and more at maplemoney.com/Borrowell. Now let's chat with Noah. Hi, Noah. Welcome to the MapleMoney Show.
Thank you very much. Thanks for having me.
So I wanted to have you on. We've talked a lot on this show about sort of index investing, even robo-advisors, ETFs, and I'm a big fan of all of it. but what one spot where I think we've had just the conversation in Canada is that maybe we're going a little wrong. Is that maybe we're a little too overinvested in especially Canadian stocks. Just right off the bat, sort of, what's your thoughts on sort of a normal sort of couch potato portfolio where it's sort of a third Canadian, a third US, and a third international?
Well, you're right. Canadians are overweighted to their own equity market. I think Canada's somewhere between 3 and 4% of the global stock market. The couch potato portfolio that you referenced has a little over a third invested in, or about a third invested in Canadian equities. Although the problem is actually, at least in a relative sense, the couch potato portfolio is actually underweighted to Canadian stocks, not relative to the world index, but based on surveys, Canadians on average have an estimated 60% of their portfolio invested in Canadian stocks.
Wow.
So although the couch potato portfolio is overweighted, it's less overweighted than other Canadian portfolios. The overweighting, your own country's stocks is not a uniquely Canadian proposition. Mm-hmm. It's known as the home country bias or the home equity bias. And the good news is, we're no more or less guilty than other people. Almost every people overweight their own country's equities in their portfolios. And we're no different than that. The explanation is basically people like to invest in things they know. Mm-hmm. So if you're a Canadian, you see Royal Bank or TD on every corner, or you see it's familiar to you, you're more comfortable investing in it. Although there's no economic rationale for it, there's actually an economic rationale not to be overweight. Yeah. To be more diversified. It's a common thing, and it comes from an emotional bias because you invest in what you know and what's familiar to you. But as I said, we're no different than anybody else.
Yeah, and that makes sense. Mentally, yes, it makes sense that like the sort of Warren Buffett advice of invest in what you know, have your Coca-Cola stocks and stuff. But yeah, I didn't realize it was what was it, 60-something% normally?
Based on some preliminary research I've done and some surveys, they suggest around 60%. Yeah. So you could say the couch in terms of being guilty of overweighting Canada, you could say the couch potato portfolio is one of the taller midgets in the room.
Yeah, exactly. It's and I don't mean to knock it. I pretty much do it myself. Sometimes I get a little out of ETFs within Canada, but ultimately it's still good that someone gets started. Like if you're going to go a third and maybe some bonds, it's still a great way to get started. I don't want to knock it completely, but obviously
I think it's a very practical, efficient way of investing for most people.
Yeah.
And probably better than what they'd be doing otherwise.
Yeah. Now obviously as you start to invest more and more money, this is going to start to matter more. What do you see as a difference in returns? Say something like couch potato or the 60% that Canadians are just sort of doing naturally compared to sort of an entire world index?
Well, the funny thing is, the longer your time horizon goes, then the more the stock market performance of any country start to all look like one another. And what I mean by that is over shorter time periods, a year, 3 years, even 5 years. Canada can do much better than the US or much worse than Europe, or Japan can outperform both of them. There can be massive dispersion in the returns of different countries where they can massively out or underperform one another. But
Mhm.
as you get longer and longer and longer in terms of your holding period, they start to converge and those differences start to basically approach zero. So if I had a 200-year horizon, just using a sort of a silly example, then in theory, being 100% weighted in one developed market versus being diversified across all of them won't make a huge difference in your return, which is interesting because the next question is obviously, so why does it matter? So why shouldn't I be overweighted if I have a very long time horizon? And I'm happy to get into this.
Yeah, well, let's get into it right now. I kind of want to show people the benefits of looking at this a little bit differently than they might be right now.
So I'm going to sort of take a step back and give you some perspective. So as it turns out, most of us, most rational people employ a certain mindset in their daily consumption patterns.
Mm.
Okay. Yet when it comes to investing, they completely abandon this sort of rational mindset. And what I mean is this. Let's say you were looking for a pair of shoes or a suit or a car.
Mhm.
Well, if you were a rational person, you would generally endeavor to buy the best pair of shoes or car or coat that you could for the least amount of money.
Sounds
That's
good.
what constitutes value. You want to get the most and pay the least. Now, as I said, when it comes to investing, they completely abandon this logical framework. So in investing, you don't get a pair of shoes or a car or a coat, you get returns. What you pay is, yes, you pay fees and they are important. But what people often forget is what you also pay is risk,
Mhm.
volatility. So just like you want to get the best pair of shoes you can for the least amount of money, you want to get the highest returns you can by taking the least amount of risk. And as I said, when it comes to investing, people abandon this mindset. They do focus on return, but they often don't focus enough on risk. So when I said before that the returns, if you have a very long time horizon of any country, start to converge towards each other.
Yeah.
They'll all start to lose the same. But when you diversify, you will lower your volatility. In any given year, one market does great, another market does less great or poorly, and you don't know which one's going to do well. Let's say you don't have a crystal ball, which is a pretty good assumption. So by diversifying, what you do is over the long term, you won't change your return necessarily, but you will lower your volatility. You will reduce your risk. And if you're going to get the same car, wouldn't you rather pay less for it?
Yeah,
If you're going to
exactly.
get the same return, do you really need the headache of extra volatility? Or would you rather get just the same amount of the good thing with a lot less of the bad thing? It's just logical. I think Eugene Fama, who won the Nobel Prize, said diversification is the only free lunch. So why wouldn't you eat a free lunch?
Yeah. So it's not so much about returns then. Truly, it's about just smoothing that out and reducing that risk.
Well, it is certainly, but there is a little bit of return element to it. Because imagine two investments, and they both get a 5% return over every 3 year period. But the first one goes 5, 5, 5, 5, 5. It goes 5, 5, 5 every 3 years. The next 3 years, it goes 5, 5, 5.
Yeah.
The other one goes 5, 10, 0, 5, 10, 0. They both have the same average return every 3 years, which is 5. But
Yeah.
one obviously one has no volatility. It's 5% every year. And the second one has much more volatility. Because of the way compounding works, even though they have the same simple average returns, the one with lower volatility will compound much better over time.
Hmm.
So actually, that's called the diversification premium. You're actually getting more of the good thing by diversifying and less of the bad thing. So you're actually getting a better pair of shoes for less money. So who wouldn't want to do that?
So if someone was just a do-it-yourself investor, how would they start something like this? Is there certain ETFs that you would use to build this sort of better portfolio?
Well, let me go back to that home country bias that you brought up and
Hmm.
how Canadians are way overweight. Couch potato, 30 something percent compared to Canada's 4% weight in the global index, or your average Canadian, which by all surveys is around 60%
Hmm.
invested in Canadian stocks. As I said, we are not different than other people, but the quote unquote sin of overweighting your home equities is a greater sin in Canada than in other countries. And the reason it's arguably a worse thing in Canada than in other countries is because the Canadian stock market itself is far less diversified than other markets. So the top 10 companies and the 10 largest companies in the TSX make up about a third of the index.
Yeah.
The US, it's nowhere near that amount, or even in Europe. We have massive sector concentrations. We basically have financials dominated by the big banks. We have energy, because we're a big energy producer, and we have materials. Those three sectors account for about 75% of our stock market. What we don't have is things like we have a de minimis weight, almost negligible in technology,
Yeah.
healthcare, consumer discretionary, consumer staples. So not only when you're overweight Canada are you failing to diversify by geography, but you are also failing to diversify by company and sector because of the individual company and sector concentration. So as I said, if you're an American and you're overweighted your home equities, that's a lot less bad
Yeah.
than being overweight Canadian equities as a Canadian because of the lack of diversification inherent in our economy and in our index. Um, Now, historically, I could argue there were some pretty good reasons for having that home equity bias, which I'm happy to go into, but also, why those reasons have gone away today. And there's
Okay.
really no good reason.
So what is that? So the pros for this bias, because I totally get what you're saying about the lack of diversity in Canada. It seems like
What's the old expression? We are drawers of water and hewers of wood, something like
the
that.
the the stocks I hold in Canada are, yeah, they're basically finance and or financial and basically utilities. There's not much else. I think I have some construction as well, but there's not a lot going on.
No, no, there's not, and there's no way around that in the near term. So the only way to diversify sectorally is to get out of Canada.
Yeah.
And just from a risk management perspective, being diversified is good, but you also miss a lot of opportunities. Like as we all know, the technology sector, the FANG stocks have been sort of world leaders,
Hmm.
and we don't really have any significant publicly traded stake in that area, in that space. So by definition, you have to leave Canada to get exposure to those opportunities.
Exactly. Can we go into what FANG is, just so that we're not leaving anyone behind?
Sure, I think it's Facebook, Alphabet, Apple, Netflix, Google. Alphabet is Google. Anyway, it's the technology
Yeah,
stocks.
I think you got it. It's back when before it was Alphabet. I think is probably when
Right.
that.
But even healthcare, like you think of things like Pfizer, these huge companies, Johnson and Johnson, Merck. We don't have any of these companies that can and probably will discover some great new treatments and medications. Especially with an aging population in the developed world, we don't have any of those healthcare stocks. You need to leave Canada to get exposure to that.
We talked a bit about the benefits of American stocks. What about international or even the emerging markets that I know everyone seems to love for the best hope of return?
Well, there are two different questions. So, in terms of the international stocks, like Europe, for example, if you're a long-term investor, what we see today is Europe certainly has its problems. It
Yeah.
has anemic economic growth. It has some political problems and political uncertainty and unrest. not least of which is Brexit. But, at the same time, one could argue that's in the price. They're trading at much lower multiples than their US counterparts.
Mhm.
And usually, at least for long-term investors, where you start in terms of valuation is a pretty good indicator of what your long-term returns will be. So there may be some bargains in Europe that you just won't find in North America
Yeah.
because of what's going on there. There may be some interesting pickings within the sort of the hurricane that's going on there. Emerging markets is a different story. I mean, I think everyone's pretty aware that these economies, um, over the next 20, 30 years will be a much harder percentage of the global economy. Their economies are growing at 5 or 6% a year, and they trade at lower valuations. Now, they are volatile. They can be a lot more volatile than developed, but certainly for a long-term investor, it's hard to argue that these things won't be a larger and increasingly larger share of global equity portfolios and emerging. They're a tremendous long-term opportunity because their growth is higher than in the developed world and they trade at much lower valuations. So there will be noise along the path, but for long-term investors, not to have a decent exposure to emerging markets is probably not a good idea.
Yeah, and I guess even though there's a risk to it, that's the whole point of this diversification talk. Is
Oh, yeah, you shouldn't back up the truck and put 100% in emerging markets, but to have a 10 or 20% weighting in emerging markets, if you're a long-term investor and you don't care what happens tomorrow or next year, would probably be a good idea.
Yeah. Speaking of the backing up the truck, I have a guy I know that he's basically entirely invested in Apple. At least that's how he lets on. That his Apple investment's been doing so great, and he's going to be set. Personally, I don't invest directly in tech stocks because I can't take the time to follow them. So what's your thoughts, sort of like just the benefit of ETFs, just in general, like, to help with this diversification?
Well, you're into an interesting thing, and this is sort of the idea of stock picking
Hmm.
versus indexing, in a nutshell. Especially in your case, your friend who owns Apple, very concentrated stock picking.
Yes.
But what's interesting is I have to be careful here, but in most stock picking is hard, not just because you have to spend the time, but even if you look at professional stock pickers, people who spend their whole lives doing this, mutual fund managers.
Hmm.
The fact is, the vast majority, net of fees, underperform the index. That's not my opinion. The data is very clear that over a 10-year period, and this is quite consistent, 90% of active managers after fees underperform their benchmark. And
For
that is a
sure.
pretty consistent number. So maybe, your friend certainly made a wonderful decision but he is not common. 90% of the pros underperformed their benchmark over a 10-year period, hence the rise of indexing. And that's probably why, even to the point where Warren Buffett has said, when I leave this earth, most of my money is to be given to charity, but the money I intend to leave to my wife is to be invested in the Vanguard S&P 500 index fund because I would not pay a manager fees to pick stock.
Well,
So
and
he's
it makes
trying to
sense.
tell you something.
Yeah, it makes
He's
sense with so
probably
many mutual fund managers out there that they're basically the market. So how are you going to beat yourself? On the whole, they are the average, right?
Well, that's right. They're
And then
not
the
really
drag of
competing
fees.
with the index, they're competing with each other
Yeah.
because inherent in those index prices are all of them.
Yeah.
So it sort of becomes a zero sum game.
Yeah, and I made this mistake early on in my own investing. I I thought I had just finished college. I was a financial analyst. I thought I know this stuff, and I was buying so many different mutual funds. I was really indexing before it was a popular thing. It was like, well, I need diversification, so I'm going to buy all these different mutual funds. But it was getting dragged down by fees. I was paying like the 2.5% fees or more, and I thought I was so well diversified, and I was, but really a few ETFs or index funds even at the time would have probably done the job.
Well, it's funny, we did an analysis, and in our minds, investing is really 99% about harvesting the magic of compounding.
Mhm.
Long-term investing is all about compounding. Compounding is the magic that creates wealth. And, fees are antithetical to compounding. They hurt your compounding rate. So if you were paying, let's say, a 2% fee, depending on what your average returns were over a 20 or 30-year period, versus, let's say, a 0.5% fee, I figure on a pre-tax basis, but depending on the assumptions, they're taking about a third of your returns.
Yeah.
You don't think about it that way, but through compounding over 20 years, you're kind of dying by 1,000 paper cuts. They're taking a third of your retirement. That's serious business.
I agree. It just doesn't make sense to me anymore. I've been very pro indexing and pro robo advisor because again, it gets people started. Like it's anyone, whether you want to follow the couch potato method or this more global allocation, it's just get started
I
and
agree.
keep the
Now,
fees low.
what I would say about ETFs is, you hear a lot of attacks on ETFs. They're this and they'll blow up and they haven't been tested or whatever the reason. And, what I would say is you can't paint all ETFs with the same brush.
Mm-hmm.
First of all, the people who are criticizing ETFs in many cases have a bone to pick because they're part of the active management industry that is sort of getting its lunch eaten by ETFs.
Yeah.
So, don't ask a barber if you need a haircut. They're biased. But aside from that, again, I said you can't paint all ETFs with the same brush. So when they say ETFs are this or ETFs are that, that's not fair. ETFs, in many senses, are no different than any financial innovation over the last 100 years. And what do I mean by that? Generally, they start off as a good idea.
Mm-hmm.
And then ultimately, the financial industry perverts that good idea into some horrible mutated form.
Yeah.
And what I mean by that is, the original ETFs, the broad-based index tracking ETFs, S&P 500, TSX 60, whatever, they were a good idea then. They're a good idea now. And at the end of the day, they will wind up engendering a massive transfer of wealth from the investment management industry to investors. And there's nothing wrong with that. However, they have been perverted. Now you have these inverse triple levered ETFs that fall. I mean, those things are in many cases toxic. And, so again, to paint all ETFs with the same brush is not right, but sticking with the more broad based, liquid, low cost index tracking ETFs, they were a good idea then, they're a good idea now.
Yeah. So some of these ETFs that have come up in the last 5, even up to 10 years, I guess, now is like you said, they're kind of mutual funds in disguise, really. Like the fees are going up and they're a lot more actively managed. So it's not really an ETF anymore anyway.
It's funny. All they've done is shift to get deck chairs. So in the sense that what we know from the data is that in mutual fund space, the vast majority of managers on a net basis underperform the index. I am sure in 10 or 20 years from now, I am quite confident that you will hear the same statement, but it'll sound something like this. The vast majority of non-index tracking, pure vanilla index tracking ETFs, the vast majority of non-index tracking ETFs or actively managed ETFs underperform the index tracking ETF. To your point, it's the same thing.
Yeah.
Passive versus active. I don't care if you call it a mutual fund, an index mutual fund versus an actively managed, or an active ETF versus an index tracking ETF. It's the same thing in a different form. Passive generally wins.
And it's easy for people to see the difference.
Apply it to mutual fund space.
For sure. It's easy for people to see the difference because all they have to do is look at the fees if they're ever questioning what's active and what's passive.
I'm biased on whether you buy the Vanguard S&P 500 Index Mutual Fund or the ETF. They both capture the same good stuff. They're low fee, they're liquid, they track an index, and they're not picking stocks.
Exactly. So this has been a great look. Can you tell people where they can find you and how you can help them out?
You can find us. We have a website, www.outcomewm.com. So outcome and then WM like wealthmanagement.com. They can find us and see sort of what we do. They can look us up on LinkedIn,
Okay.
Outcome Wealth Management. There's a couple comments I wanted to leave you with, though, in terms of why today is different in
Sure.
terms of home equity buyers. So in the old days, the truth is exchange rates could be a huge source of risk and volatility. So if you invested as a Canadian in US stocks, even if the stocks didn't move up or down a penny, if the Canadian dollar rose 10% against the US, you just lost 10%. So currency risk was a huge thing.
Yeah.
That has gone away because now you can buy ETFs that have the hedge inside of them. They're currency hedged. So plenty of ETFs. You can buy the S&P 500 in Canadian dollars, which is hedged. So that goes away, that old concern of not wanting to go outside of Canada. The other thing was currency conversion. So if you wanted to buy US stocks, you had to take your Canadian money, convert it to US to buy US stocks. And you got murdered on that conversion. You went into the bank and they typically spread you 3%. For nothing. On the most liquid market in the world, they took 3%. And then when you sold your US stocks and wanted it back in Canada, they took another 3%. So you start underwater 6% before you've even done anything. And by the way, that's no different today. But again, today you can buy currency hedged ETFs and not have to cross that horrible spread. They hedge for much lower cost. And the other reason you'd want to diversify is, again, when you look at how most managers underperform, in Canada, when you look at Canadian domiciled managers who manage foreign exposure, it's not 90% that underperform their benchmark, whether it's the S&P or Europe. It's about 95 or 97. It gets even worse. So Canadian managers don't have a very good track record when they're managing foreign equity exposure. There's another reason to buy foreign index ETFs.
Okay, that sounds great.
There's one last reason why you would be overweight. So far I've told you all the reasons why you should be more diversified, how it's silly why not to be. You reduce risk, you increase your long-term return. There is one reason why you would be overweight Canadian stocks.
And what's that?
Has to do with tax. Canadian dividends are taxed at a lower rate than foreign dividends. So, and that's sort of an artificial thing that the government's created, but that would be one argument that still exists for being slightly overweight Canadian stocks. Not 60% overweight, but slightly overweight because you get a tax break.
Would that just be outside of the registered accounts?
Yes.
Okay. Yeah, and that's totally good reason. Don't
get me wrong. To get a little bit of a tax break and be 60% weighted in Canadian equities is a mug's game. That's a bad trade. That's the tail wagging the dog. But you can be somewhat overweight Canadian equities.
Yeah, exactly. Another similar thing I do is I keep a lot of my Canadian ETFs and stocks outside of my RSP and TFSA for that reason. Just that because you called it exactly. The tax benefits are there, so keep the other things in the RSP.
Yeah.
Okay. Well, thanks for being on the show.
Yeah. Thanks very much.
Thanks, Noah. That was a great look into how we can better diversify our portfolio. You can find the show notes for this episode at MapleMoney.com/Noah Solomon. If you're enjoying the Maple Money Show on iTunes, please leave us a rating and review. Not only can it help the show grow, but I read all the reviews as I really want to know what you think. And thanks to you for listening. Next week, we're going to have Paula Pant on the show where we'll be discussing how to escape the 9 to 5. Hope to see you there.